For those of you who don't know me, I'm Anissa, and I'm going to introduce my group.
My name's Timmy.
I'm Julia.
I'm Rahil.
And today we're going to be talking about Chegg. So I think a lot of you guys are familiar with the company, but for those of you who aren't familiar with the company, it's an online website where students, like university students, can rent textbooks for a discounted price. So it started in 2005 in Santa Clara, California, and the CEO is Dan Rosenberg, who's the ex-CEO of Yahoo. So he was really passionate about the slogan of the company, save time, save money, get smarter. The company went public in November 13, 2013, and since then they've been very successful. To kind of show you guys how successful they've been, I've included the revenue from 2014, which was $304.8 million. 91.2 of that was electronic or digital revenue from like ebooks. So how do they make that money? So there's two ways, from advertisers and from students. So students renting the books obviously are giving money to the company, and advertisers are paying them to match them with students, brand ambassadors, and other employers. So kind of what we're going to be talking about with this company, I think it helps with the little story. So Julia was about to return her books because we're coming to the end of the semester, thankfully. And so she had this project in mind, and she went to the investor slide of the website, and she saw that it included two different revenues, one that was non-GAAP and one that was GAAP. But the variance was so extreme. One was a net loss and one was a gain. And so we all kind of found this really interesting, and we wanted to kind of know, is that fair for an investor to see both? Would that confuse them, and why they do that? And so it's kind of what we're going to be talking about today, and kind of come up with a position on whether we agree with this or we don't. I think in order to understand that, we need to understand what goes into non-GAAP and GAAP, and Timmy's going to explain that.
So what are the differences between GAAP and non-GAAP? To start off, GAAP stands for Generally Accepted Accounting Principles. These are usually more regulated and time-honored. So you can think accrual accounting, time, revenue recognition, and expense matching. So the SEC requires companies to use GAAP mainly because it includes uniformity as well as comparability. So if all the companies use the same type of financial statements, and investors have the ability to look through and really understand how these companies are different from each other. Non-GAAP, on the other hand, is less uniform because it's used as a supplement. So if you want to use non-GAAP, you first have to provide your GAAP financial statements, and then in addition to that, you add non-GAAP. So these are usually different between different companies depending on how they function, and there could be multiple different ways they use it. They could use adjusted EBITDA or diluted EPS or free cash flow. So I'm going to go ahead and pass it on to Julia to make you understand more why Chegg uses non-GAAP as well as GAAP.
Alright, this is a statement from Chegg's website that describes why they've chosen to use non-GAAP measures. And pretty much they feel that for investors to fairly evaluate Chegg's performance, they want to exclude the numbers that don't represent their core business, their future outlook, or their operating results. So now we're going to look at some of their quarterly reports. And this is a comparison of their GAAP net income to their non-GAAP net income. And as you can see, for the fourth quarter of 2013, they reported a GAAP net loss of $5.4 million and a non-GAAP net income of $20.3 million. So it's a big difference. And the trend kind of continues where the non-GAAP is always better. And then on to the annual report, they do have all their GAAP stuff. Everything looks good. It's the same as every other company. But then on their website, you can see their non-GAAP. Or in their financial highlights, they have their GAAP gross profit, non-GAAP gross profit, adjusted EBITDA, GAAP net loss, and non-GAAP net loss. So they present a lot of different information that you don't just see in their financial statements. And now Rahil's going to talk about how they got to those numbers.
So since the number is so different, how exactly did they get to that number? Well, it's a combination of several different things, and I'll talk more about the numbers on the next slide about reconciliation. But first of all, for EBITDA, they calculate it as earnings before interest, taxes, depreciation, and amortization. And that's composed of a lot of different costs and expenses, such as compensation expense, amortization of intangible assets, and impairment. And that really leads to a reduction in their operating expenses, and that makes the biggest impact on their income for non-GAAP. And another thing they have to decide on is whether to include non-recurring items, and that could be anything such as just various fees, lawsuits, or just acquisition costs. And I think that really makes a difference also about how they get to the bottom number for income. And gross margin isn't really affected too much by this, as much as the expenses are, because gross margin would, the only thing they reduce is the stock-based compensation expense, which isn't really a big number for them. So that remains about the same. So on the next slide, we'll see the reconciliation of GAAP to non-GAAP. And they basically provide this as a supplement, and it's to show kind of match each number from GAAP to non-GAAP to kind of show how they got to those numbers. And at the top, you see their revenues and how they got to gross profit, which, as I said, it's about the same because stock-based compensation expense isn't a very large number for them. So the percentage is about 54% for non-GAAP and GAAP, whereas operating expenses right below that, it's quite a bit different. And we see that because of amortization of intangible assets, impairment, and acquisition costs. And those really make up a huge chunk of how they got to non-GAAP operating income. And it basically cut it in half. So we see that in GAAP it's 51%, whereas in non-GAAP it's only 34%. And in the end that leads to a higher operating income. So Chegg obviously isn't the only company that does this. So I'll let Julia give you some more examples about it.
Alright, so we did a little research and we found that a lot of big name companies like Google, Twitter, GoPro, and eBay also present non-GAAP measures for their investors. And Amy is going to conclude now.
So as a group, we were trying to decide, is it fair? Does it make it more complicated for investors when they look through these financial statements if it's not uniform across the board? But we have to keep in mind that the SEC is fine with it as long as you provide the GAAP financial statements as well as a reconciliation like Rocco showed earlier.
So kind of like bouncing off of Timmy, if the SEC is okay with it, if they're providing the GAAP financial statements along with this extra information, I think investors shouldn't be as confused because as Chegg has provided exactly how they got to the numbers, exactly where the actual numbers are from the GAAP financial statement. So they're kind of giving investors both sets of numbers. And they're kind of telling you on the non-GAAP side what exactly they believe is their actual revenue, minus all the expenses that Rocco was talking about. So we believe that I think the investor will make a very educated decision on whether they want to invest in the company.
Yeah, definitely from the beginning we kind of thought about it in a negative way, kind of like we thought it would be too much information and it would be kind of confusing for investors, especially just people like us where we're not really familiar with things, as many things. But after doing more research and getting to know more about how they calculate their non-GAAP numbers, it definitely makes sense, and we definitely think that it's useful for most people. And that's obviously a lot of other companies do that too, which was surprising at first because we thought it was only Chegg or just a few companies that did it. But if a lot of other major companies do it, it must be a big deal, and we strongly believe that it really is helpful.
Any questions?
So if you were an investor, would you make your investment decision on non-GAAP financial statements or GAAP?
The GAAP financial statements, just because you could still see it across the board with other companies and compare. But I think it's helpful just because you can kind of see like the depreciation is like for the books or in this.
And since it's like different companies would have different ways of, I guess, calculating expenses, and Chegg kind of has a textbook depreciation, and that could be for regular GAAP you might want more information on it, so people could go to non-GAAP and kind of see how they calculate those different expenses and how it affects income in the end.
The common thread in those companies appears to be that they're all in the technology industry. Is there a reason why that industry in particular seems to adopt the use of non-GAAP?
I think a lot of it is that they change so fast and they like to exclude the numbers that are extraordinary. So the liquidation, and I think those are the expenses that they all kind of share in common because it's changing so fast.
Great job, guys.